So let's talk about short covering. So if you got market in the run of a day, let's look at this here, this profile. So it's kind of like a P-shaped profile. So basically, where's the opportunity in the run of a day? So it opened down here, and then it ran up, right? You can see C, D, E, F, G, right? And then it kind of moved around. But look, so we see in the future the market goes to the downside, right? But look, so here, the market was not ready to go down, right? But some people did try to short it. And when they did try to short it, people bought, right? So this structure weakens the market, right? So it's kind of hard to understand because, okay, people did short it, but they closed their order. Okay, so they went long to close their order, right? So when they went long, when those longs are finished, the market's weaker, if that makes any sense, okay? And you can see it, okay? So let's look at here. Market spent a lot of time in this area, okay? And then when it went down, you can see the capital I up here. We have a single print, okay? So that represents a selling tail. Not much of a selling tail, but it is a selling tail, right? Right, so as it came down, so that's capital I, right? So look, we got a capital Z, and then we get the A's, right? So somebody sold here, and then somebody took profit here, right? So as they closed their order, the market rose up. So we get the little a, and then the little b, and then the little c, little d, little e, f, g, I see G, H, I, J, K, L, M, and well, P, okay? And then look, P, and then Q, I see a V, and look, the close is right here, right? So what did that do? Okay, well, it's not very intuitive because, okay, yes, there was shorting, but look, when the market rose up again, new business did not come into the market. So the people that were long, they were long only to close their shorts, right? So they're getting less and less and less buying pressure in this market, right? Now, it looks easy because, okay, yeah, it's a big initial balance, so it's going to be hard for the market to break it anyway, right? And the market really doesn't go anywhere, so we can say, okay, old business, and there was no introduction of new business, right? And then the following day, look at this. Following day gets interesting because you see, even though it opens with a small initial balance contained within the previous day's value area, right? So now it's going to be easy for the market to break that, right? So if you weren't short in this day sometime, well, get short, right? Because these are the type of days that you don't want to go for coffee, as they say. Like if you're trading in the pit and you say, okay, this market isn't doing anything, right? And then you go for coffee and then all of a sudden the market moves, right? You missed it, right? Because you think, oh, there's not much movement, right? But we know in consolidation that happens before breakout, right? So in the value area is overlapping, like this day. Now this day, look, it's still overlapping, but look, it's shifting down and the point of control is moving down, right? So we don't see much of a selling tail, but you can see the result. So effort versus result. You see the volume up here, cause and effect, right? Wyckoff, boom, right? So you can see like in the past, okay, I don't have an incredible amount of data. You can actually change that if you go in here. You can modify any of this. So I showed you some of this in one of my other videos. So I've got profile number 50, so I'm backed way up, right? But you can change that. And you can also change it profile type, so like you can switch this monthly, weekly, or whatever, and then essentially each print would be 30 minutes, right? Which is the normal setup. Okay? So coming back here, yeah, you can see the market ran up, right? In here, we had evidence of selling, even though it's 3 capital U's, that is selling. Right? And then the market, as it came up here, it failed to move the point of control up, right? It went all the way up here and then retracted, right? And same thing, right? Point of control was here, now it's here. But look, it tried to spend time here, but it failed, right? And then boom, coming down. So Wyckoff would say, okay, here's your weakness, a sign of weakness, SOW as they call it, right? Sign of strength would be to the bullish side, right? And then you can see the chugging and the chugging, because there's people getting short, as people scalp on the lower time frames, but that potentially when the higher time frame traders get interested, right? You would say they're more interested in this area, right? But you could be talking, okay, when is Goldman Sachs trading? When is Citibank trading? Well, they could be all different time frame traders, right? You don't exactly know unless you're actually in the industry which group is who, but you can be certain that when we have a breakout, there's multiple different types of time frame traders, and when you have a trend, they're all working together. When the market is consolidating, there's only a few of these groups working, right? So say if you're a scalper, yes, you're in the market, you're scalping, okay? You're causing volume, but then as you breakout traders, maybe algos are they see a breakout, they're trading, right? They see increased volume, and look, you can see their effect. You can see these 2 little single prints, little tiny excess, much bigger excess, and you can see when the market comes back, it basically respects this previous excess, right? So, but anyways, I want to show you in this video, P-shape, short covering, weakened structure, right? So let's go find another example, right? So we wanted to understand context, right? So would we use this just based on P-shape? Who cares about trend? Well, that's the thing about market profile, is that it's all about context, and you can't just take any of these concepts. Like, you got to understand like the entire picture. But time, it all relates to time, right? So okay, so you can kind of see it here. This is a messy example, but it's the same idea. So the market rises up, right? We see this is an old trend, right? So okay, here trending, right? We have a definite decision to go to the upside, and the market continues up, right? Continues up, and now, okay, what happened here, right? Now, if I was looking at a bar chart and I saw, okay, big bearish candle and run an uptrend, wouldn't I think the trend might be finishing up, right? So you could think of it that way. Jesse Livermore alluded to some of these ideas, as well as David Weiss, if you read his book. Basically, you can see it here. So as the market rises up, we have overlapping value areas, and the point of control is increasing, right? And I see buying tails here. So I see a very small selling tail here. So perhaps the market is not ready, but look, it is P-shaped, okay? So there's weakness coming into the market to the downside, right? It's just not ready yet, right? And you can see the next day, the initial balance was really small, overlapping to the previous day, okay? Point of control is higher, but look, why is June 16th different from June 15th? There was clearly something changed in the market, and we have a move to the downside, right? So we had enough time for price to take up volume here, right? So we have a cause built, and it's the effect, right? So a decision was made yet again, boom, to the downside, right? Point of control is continually lower. We have, see, point of control up here, point of control down here, right? But look, our value area is still sort of overlapping, right? So I know something is not quite right. Like, there's no gap here, so we're not gonna have a really, really good run, right? It's just gonna go down a little bit, right? And then down here, see again, value area, and then look, boom. Okay, point of control is lower, value area is lower, But look, we have a poor low here, so I know the market's going lower, but you know what I mean? So it's all these things you gotta take. You can't just like, Mark Douglas talks about mechanical trading. Like, and if you use an indicator and you say, okay, price crosses the indicator or the indicator crosses another indicator, well, sorry to say this, but that is mechanical trading, and there's other different higher levels of trading, right? So it's like you see opportunity, right? And if you don't act, well, you're going to miss out, right? Same thing if you're in a trade. Well, if you see you see your trade going the wrong way and you don't act, well, it's either you could take a loss, you could have reduced profit, leave money on the table. They say the 4 fears of traders, right? So you're essentially going to be subject to that. But you can see, like, I haven't shown you a bar chart yet in this video, and we can look at the market very accurately. I'm not, obviously it takes time to explain all this, but if you keep at it, it might take you a couple of weeks to learn this, but essentially it's a new skill, right? So then you can go on different time frames, right? But traditionally, market profile is used on only the 30-minute, right? So each profile is in the run of a day, right? And then that's each day.